All right, welcome traders. So today I want to quickly teach you how to trade with engulfing candle. Okay, now engulfing candle pattern is one of my favorite candlestick pattern because its signals are always mostly sure. Okay, now I'm not saying that it's going to work every time, but most times it's always sure if you use it correctly. Okay, now the purpose of this video is to teach you how you can spot it and how you can use it correctly to ensure your success in trading. All right, so without wasting much time, let's just hop into it. So first off, what is the engulfing pattern and how does it actually look like? So the engulfing pattern, just like the name says, is a candle that engulfs another candle, kind of like a big candle that covers another candle. Now we have two types of this. We have the bullish engulfing, that is a candle that is engulfing a bullish candle, okay, going up, and the bearish engulfing, that is bearish candle that is engulfing another candle. Okay, so in this portion, in this bullish example, this big candle is a bullish one, meaning is engulfing a smaller candle, probably another red candle, that is a bearish candle. While in the bearish example, this candle here is a bearish one. So let me just draw it. Let me draw a bullish engulfing just to show you how it might look like. A blue candle that covers the red candle. Okay, why for the bearish example is going to be like this. So the red candle covers the blue candle. So this is a bullish engulfing, okay, while this is a bearish engulfing. Now I'm going to put a picture, the real picture of it on the screen so you'd see. Okay, so the major thing, the important thing is to understand how this candlestick is actually sending us a message. What does it mean? Okay, now we know how candlesticks are formed. If you are here and you have not seen my video on how candlesticks are formed, there's a video on my YouTube channel. You can check it out. Okay, I might tag it right now. When candlestick open, two things can happen. Either the candlestick is bullish or bearish. So a candlestick can decide to start going up when it open. That is, it start going up, or it starts going down. So let me use the right arrow. So either it starts, okay, when it open, or it start going down. So it can either be going up or it start going down. So when a market open, it can either start moving up like this, start going up. Okay, so imagine this place is filled. This place is filled. Just imagine it's filled. Okay, or it can start going down. Okay, these are two things that can happen when a candle open. So when the candle, now before the candle closes, if it have gone up, let's say this candle opened at this portion, okay, it went up, but then before it closed, it came back down and closed bearish. This candle is going to what have something we call a wick. So that's how the wick comes about. Okay, that is the wick, because the market attempted to go up before, but it did not close up. Instead, it went up and came down, then it closed bearish. Okay, so the candle is going to be like, it's going to have a wick. Okay, but this is not what we're talking about today. We're talking about the engulfing pattern. All right, but it sends the message, and that is what I want you to actually understand today. For the market to go up, okay, go up, but did not close at this portion. Okay, not close at this portion. Instead, it was pushed down. It means that the sellers were more strong. You know, it means that the sellers were willing, or they were able to push the price down, okay, to this portion. So use a let's say a can of sugar or a cube of sugar, for example. Let's say a cube of sugar came to the market, okay, entered the market, and the buyers were able to push a cube of sugar that day to $10, okay, $10, right? But before the end of the day, before the end of the time frame, the sellers were able to push that price down to $1. Who do you think is actually stronger? It's the sellers. Okay, and if the price ends like that day, it means that what the sellers were actually stronger. Although the buyers came with higher momentum, but the sellers overpowered them at the end. So that is kind of the language that this candlestick speak. Okay, now this part of the candlestick is called a wick. Okay, this is a wick. All right, now I'm going to put the real structure of a candlestick in the right side of this video so you see. Okay, why this part is called the body. So let's look at the real candlestick so that you see for yourself. This candlestick now, okay, this is the wick for this candle. Okay, this one that looks like a line or an eye is the wick of the candle. It means that what it means simply, if we are to look at this candlestick, is that the sellers, when this candlestick opened here, okay, the sellers tried pushing it down. Okay, try pushing it down. Okay, it was going down, it was down. But before the time frame closed, before this daily time frame closed, so the buyers were able to push the price back up and it closed bullish. Okay, so that is why the wick was now formed behind. That is just the wick is just telling you that okay, when this market actually opened, the sellers were actually having more momentum. Okay, sellers were having more momentum in the market. Okay, so that's how this candlestick is formed. So for the engulfing candle, what actually happens? Okay, so for the engulfing candle, you notice that there was a small candle, there's a smaller candle that's always before it. So let's use a bullish engulfing, for example. So let's say this was a bearish candlestick. Okay, then after the closure of this candlestick, the buyers just came. Okay, so of course the bearish candle closed here, closed below, closed bearish. Okay, then the next one, the buyers just came and they just pushed the price up. Okay, without even giving the sellers chance to do anything. Do you understand? They don't even give the sellers chance to do anything, to even move the market down at all. Okay, so this is what makes the engulfing pattern very powerful, because it just shows that the buyers entered the market with momentum and they closed with the momentum. That's the important thing. So they pushed the price up and they closed with the price up. So this is what makes the engulfing pattern an important message. It's showing that what the bulls now, in this example, the bulls are what are stronger, or the bulls have higher momentum in the market. Okay, so is the reverse for what, for the bearish engulfing. So the bearish engulfing, which was like, let's say the market actually was trying to go up, a small candle, then the bears came in, and when the market opened, they pushed the price down and they closed down. You get me? The important thing is that what they closed down. You get? So that means that what, that the sell actually entered with momentum and they closed with momentum, and that's what makes the candlestick what powerful. Okay, now you understand how the candlestick look and how it's formed, right? Now, how exactly or when exactly is the best time to use this candlestick? This candlestick speaks better language at areas of value. Now, when we mean areas of value, we're talking about areas of maybe support, resistance, okay, maybe trend lines, maybe order block, maybe whatever you want to call it, breaker block, any zone you want to call it at all. Okay, any zone at all. This candlestick speaks volume. It shows that what either the buyers or the sellers are in control. Okay, so how do we use this candlestick effectively? Let's take the bullish candlestick for example. When is the best time to use a bullish engulfing? Okay, we use the bullish engulfing at areas of value that is supposed to be an area where we want to buy from. So let's say we were trading this market in an uptrend, and the market come back to this portion. Okay, of course, you know that at this portion we are looking to buy, right? So market come back to this portion and you see a bullish engulfing. Okay, so let me use the color, and you see a bullish engulfing at this portion. It's showing that the buyers have actually stepped into the market with momentum. Okay, so it's giving you a signal that this market actually was very, very, very likely to buy. Do you understand it? So the point is what you have to use this candlestick at areas, okay, areas of value. This is how to use it effectively. You have to use it at areas of value. At what? At areas, at key zones. Okay, so when you are looking to buy, maybe a support zone or an order block like this, so you should be looking for probably a bullish engulfing pattern. So if you see the bullish engulfing pattern, it shows you that okay, the buyers are actually willing, they are ready to step into this market. And you know what? You can trade with it. You can basically enter after the closure of the candle. Okay, and we'll put your stop loss below. So let's look at live examples. Okay, now one thing that I also want you to note is when you're using a bullish engulfing, you should use the bullish engulfing in either because we have 3 time frames, okay, for taking through. We have the confirmation time frame, Okay, we have the corroboration time frame. I'll have the main higher time frame. Okay, that is the main, the biggest higher time frame. Are you getting me? That is the big one. Now, if you are here and you don't know how to combine time frames to your trading, I have a video which I've already made. Okay, this is something I teach personally. I use the 6 to 8 rule. Okay, when I'm working with time frames. So 6 to 8 rule is going to give you an easy way to actually know a time frame to use depending on the kind of trader you are. So 6 to 8 rule. So I divide my higher time frame by any number between 6 to 8 to get my corroboration time frame. I also divide my corroboration time frame by any number between 6 to 8 to get the confirmation time frame. So if you are here and you don't know how to do that, you can check out the video. I will tag it right now. So the thing is, what you have to, when you are looking at this candlestick, you have to look at candlestick, because candlestick that is shown in a higher time frame has higher momentum, meaning higher time frame candlestick works better than a lower time frame candlestick. So if you see an engulfing pattern in a higher time frame, it gives you a better signal that the market would actually move in that direction. Okay, so let's just look at examples. Let's look at this portion. Okay, so if you look here, you can see that this portion, okay, is an area of support, right? Life example. So you can see that this area is an area of support. Now, how I'm actually on this trade right now, USJPY, I'm actually on this trade, and this is exactly how I caught the trade. So how exactly would you use this? So you go in now. In this zone, this is a support zone. So what are you looking to do? You are looking to buy. So what you should be concerned about is the bullish engulfing, right? We are not looking for bearish engulfing here now. We are looking for bullish engulfing, because at this zone we are looking to buy. You understand me? So if we zoom in, you see, did the market really give us an engulfing? Did it give us an engulfing? Well, it gave us a hammer, but after the hammer there was an engulfing pattern. But for the purpose of this example, let's not use that because it's not so perfect for you. Let's just go back in time. Okay, let's go back in time, and let me look for a perfect example for you. So if you look here, you can see that this market, okay, now I want you to imagine that this was an area of value. Okay, I don't know, I did not really go down to look at it, but let's just imagine that this was an area of value. I get me. Let's just take this zone. Let's say it's a zone. Okay, because I told you that you have to use it in a zone. Okay, you must use it in a zone. I just want to give this as an example for you. So let's say this was a zone, all right, that we're looking to take a trade from. All right, so what happened when the market gets to this zone? What does it do? Okay, after playing along here, it comes back and it gives us this. This is what? A bullish engulfing. Because if you look at it, it engulfs towards the bearish wall well. Okay, it covers it well. Now, that's sometimes you are going to see it like this. Okay, this is a perfect example. Why sometimes you might also see it like this. But the truth is that what this candle drastically covers the bearish one. Okay, so this is a bearish. This is a bullish engulfing. And how you enter the trade is what you just simply wait. Okay, because most time after the bullish engulfing, the market might actually come back. Just take 50% of the candle. You understand me? So when you want to take the trade, just let's take our trading tool for example. So mark out 50% of the candle. Okay, that is the half of the bullish candle, the engulfing candle. Then you take your trade from there. Okay, that's where you take your trade. Then you can put your stop loss below the lows or the low of the candle or below the entire zone. Okay, depending on the risk to reward you want to use. So let me do that right away. So there's my 50%, and I'll just put it either below this portion. Okay, below this portion. All right. Or I can just take it below the whole zone. So it depends on the risk to reward you are looking at. Okay, but below the candlestick, okay, that is the candlestick that formed the engulfing, the two of them is actually okay too. So you can take that and to extend your reward. Okay, depending on the zone you are trading. Okay, like I said, I'm not really analyzing this market for you. I'm just giving you an example of how you can use it. Okay, and if you look as long as you took the market from an area of value, you are safe. Okay, just take your trade, put your stop loss below, and let it ride. Okay, let it run. And if you look, you see that the market actually played out. Okay, gave you your TP, although it took some time, but Although it took some time, but of course, it depends on the time frame you're also working with. Okay, so you can see this is how you actually use. So let's just look at a bearish example quickly. So now you see here, this is a perfect example of a bearish engulfing, like a perfect one. So if you look at this portion, okay, you see that what this red candle fully engulfs the bearish one. Okay, and like I said, I'm not really analyzing the market, just showing you how you can use the candlestick. So let's imagine this was a zone. Okay, let's say it was a resistance zone. Okay, and you see this candle there. How do you use it? How do you enter the trade? Like I said, well, look forward just 50% of it. That is the half of it. Okay, because if you want to enter at the ending of the candle, your RR will be what? Too poor. Okay, most times your RR is going to be poor. So 50% is when the candle closes, make sure the candle closes first. Okay, so you make sure the candle closes first. Then when the candle closes, go for the 50% of it. Take your tool, take your short position tool. Okay, you can put your stop loss just below the candle itself. Then you move forward your reward. So what we usually advise is what, don't aim for anything less than 3 to 1. All right, so if you are trading, always try to follow at least 1 to 3 risk to reward. So move at least 1 to 3. Okay, at least 1 to 3, and you see that what eventually when you move forward, you see that the market respected, and what the TP was hit. Okay, so this candlestick is a very, very powerful candlestick if you just follow how to use it. If you just follow how I explained that you should use it. Okay, so like I said, first you have to use it at a key level. So if it's bullish engulfing, you have to use a bullish engulfing at an area of support or an area where you are looking to buy. So when you see a bullish engulfing as an area where you are looking to buy, just go for the 50% of it. After the candle closes, take the 50% of it, move your stop loss, put your stop loss below the candle, then ride the market. Okay, at least 1 to 3. And the same for what? The same for a bearish example. I'm not just telling you to go and use it. Go and try it out for yourself in the market and see for yourself. Okay, go and see it for yourself. You see that it works. Okay, then you can now start employing it in your normal trading. So before I end this video, of course, I should keep you informed in case you are a beginner to trading and you don't really understand most of this stuff we're talking about, and maybe you are trying to learn from YouTube. Of course, learn from YouTube is very, very hectic. I have a training ebook that could actually help you. Basically, in fact, is your answer. Okay, you are looking for someone that's going to guide you, that will take you by the hand to guide you through the step-by-step approach. The FSB trading ebook is your answer to that. Okay, the FSB trading ebook is a book that has been tailored to guide you from the beginner, the very scratch, the beginner level up to the expert level. The book comes in 3 copies: the beginner, the intermediate, and the expert session, or the expert trader. Okay, this is your compass to trading. Everything I teach, everything I talk about, including this concept I talked about today, is all embedded in the book, in the trading ebook. So to ensure your trading success, all you have to do is what? Is get a copy. Okay, there's a link in the description to do that. And also, if you want a one-on-one session with me, like you want to join my mentorship, there's a number in the description where you can also reach me directly for that. All right, don't forget to like and subscribe and share the video to all those that are also interested in learning trading. Don't keep the knowledge only to yourself. Share the video, like and subscribe. Until we meet again, peace.